We start today's market talk. This volatility underscores a fundamental principle of investing, the importance of diversification through proper asset allocation. This recent market behavior serves as a timely reminder to the risks associated with equities. This volatility makes concept of primary asset allocation and regular balancing critical to align with one's risk tolerance and financial goals. Equity is crucial for long-term wealth creation, but fixed income is essential stabilizer every portfolio needs. Market outlook. US equities, US markets continue to ride the Trump rally. US equities have done well this month despite missiles being fired between Ukraine and Russia revising its nuclear weapons policy. The reasons are that the market believes Trump will end the Ukraine conflict and it will bring down the inflation all over the world, and he will also repeat his first term policies, basically of reducing the corporate taxes, so which will help the earnings. Market is not concerned about rising fiscal deficit in US, higher government debt, higher tariffs which may lead to higher inflation, and Fed pausing rate cuts due to higher inflation. Market is definitely positive on promise of artificial intelligence. Now Bitcoins are eyeing a $100,000 milestone. Bitcoins and other crypto tokens are in a rally for the past couple of months. Prices have zoomed once Trump came into power. India's flash PMI shows growth accelerating, but so is core inflation. In response to rising operating costs, private sector companies in India have hiked their prices due to demand strength. In addition to sharp surge in food inflation, core inflation has edged up. Now, November flash PMI came in at 59.5, higher than September and October levels. It implies private consumption is back to being the driver of domestic demand. State election outcome would be sentiment positive, but many fundamental worries linger, and domestic investors have continued to support the markets. So in spite of sustained selling by FIs, equity markets are gearing up for a fresh rally after the uh, after the election results. Though the fundamental worries are earnings slowdown in Q2, FI selling due to performance gap with the US, no imminent rate cuts in India, and in spite of all this, there is a lot of noise. So one has to look to buy the lows only. Reasonable valuations and performance will definitely find takers. Coming to US markets, Nvidia delivered quarterly revenues that doubled year on year and data center revenues that climbed to record $31 billion. But revenue outlook was lower, that sent the shares falling on Wednesday, but the stock rebounded and ended higher. Bitcoin is emerging as the most prominent Trump trades. Now, if you see here, the US bond yields, after the rising trajectory, they fell, came down to that 3.5 level, and now after that, in October, the trade has reversed and the bond yields have reached 4.5 levels. Now, what happens from here, we'll have to see whether the bond yields still go higher or they come down in case there are rate cuts, etc. So this has to be watched. US dollar index continues to head higher. It has retraced more than 100% of the previous high it had made, and now it is trading clearly above the declining trend line. So now it's no longer in a bear market, it's in a bull market and may go head higher. Brent crude was slightly positive last week uh, based on expectation of higher demand, etc. But it has rebounded from that 70 level and still below the 20 and 50-day moving averages. Gold rebounded from the 20 EMA on the weekly charts, and now it's above the last week highs. So it is now looking positive. It has halted the decline it had for 3 weeks. Copper has corrected last week. It declined around 0.5%. and it is above below the 20 and 50 EMA because of expectations of lack of demand and higher supply. A Bitcoin US dollar, this is a weekly chart. So it made a beautiful rounding bottom and then it declined, took support at the 50 EMA, and then it has zoomed up to nearly now $100,000. So let's see from where it goes from here. Nasdaq continues its upward trajectory. It had a positive week basically due to Nvidia results, but the trend is overall positive and making higher highs and higher lows. Same with Dow. It it had a strong green candle and was up 1.96% because of overall positivity for corporate earnings. Now coming to India, India VIX rose last week and it went up to around 17 odd levels. From there, it should decline next week now because most of the news is known already. So not much of events are likely next week. Nifty, coming to technical charts of Nifty, on the weekly chart saw a piercing green candle, roughly 50% of the retracement of last week's red candle, and it bounced from the 50 EMA or that 2023 250 odd levels, where it had come down after the retracement of the rally from the 4th June low to the high it made around 26,300 odd levels. So that 61% retracement was done, and from there it bounced. Right now it has reached that 23,900 level. So we'll have to see what happens from here. Coming to the daily charts, uh, it formed a dominant green candle on Friday, engulfing the bearish moves of the last 5 sessions. Now it has taken support at 200 EMA. It traded below the 200 EMA for a very short time, but then it has bounced back. Once it goes above the 20 EMA, that should be a decent level to trade long. And you should only short if it goes below the 20 EMA. 20 EMA is roughly around 24,020 levels. So that is to be watched. The next resistance should be around this 24,400 to 24,500 levels, uh, where it had halted for some time earlier. And after that, the next leg of fall had taken place because after the first leg of fall, it had come to around this 24,700 level. Then it had risen, then come to this 24,400, 500 levels, and then the fall had taken place to 23,500 level. So this has to be seen. On the hourly chart, it had oversold last week. It bounced and then it dipped during midweek and then it had a rise. Now it is clearly above the 20 and 50 EMA. So till the time it is above this 23,714 level, that is a 50 EMA on the week hourly charts, it is positive. So this is a critical support at the lower levels. Nifty Bank also on the weekly charts was up 1.9% and it retraced some of the fall and has now come exactly at the 20 EMA uh, on the weekly charts. So it should go up from here. On the daily charts, it has come to 20 EMA, bounced from the 200 EMA levels of around 49,900 and now it is at around 51,200 odd levels. So for any sustained up move, it has to trade above 51,440 levels and then the next set of resistance will come at around this 52,400 levels. Now the HDFC Bank is the one which rose this week from the lows it had made last week. It had gone to around 1670 level. It rose this week and this resistance zone of 1770 to 1800 is critical. So once it is able to cross this in case with momentum, then it will make fresh high. Otherwise, it will again retrace from here. Sorry. Reliance, it's again at a critical level. It took support at the 200 EMA or the 78.6% retracement of the rally from 1100 levels to the high it made at around 1600 levels. So now this is at a critical point. So if it retraces, bounces back from here, that is critical. It nearly tested the 200 EMA on the weekly charts, and if this level breaks, it will go down to this 1100 level. So one has to be slightly careful. Mid-cap index was slightly comparatively weaker, and it has taken support at the election day high of 4th June. Uh, Similarly, for small cap index, similar charts, again it has taken support at that election day high of 4th June. Now I'll cover three stocks today. Now, first is Syngene. It's an innovation-led contract research, development, and manufacturing organization offering integrated scientific services from early discovery to commercial supply. It built upon weak base of Q1 and highlighted positive signs of recovery in discovery services. These were largely driven by pilot projects with large and mid-sized pharma customers looking for alternatives to China to de-risk their supply chains. After two lackluster years, where constant currency growth was in single digit, a robust rebound over FY 26-27, especially as biologic capacity increases sharply in an environment where global demand is likely to remain strong. Development and manufacturing saw steady growth on back of biologics manufacturing and higher number of process development projects in small molecules year on year. Gross margin recover even as operating leverage drive as much stronger than expected operating margin to 27%. Q2 capex as at $12 million, large part of which on discovery series around biologics to upgrade the required Stelis facility in Bangalore, which they have recently acquired to make it ready for operations in H2 FY25, that is now in the upcoming quarter, have sufficient capacity in terms of people, and capacity and growth is more dependent on extent of client demand and service delivery. Now, coming to their quarterly results, it showed a 12% year-on-year, Q-on-Q growth, but declined 2.1%. Similarly, EBITDA was also up 38% Q-on-Q, but declined 11% year-on-year. That means the margins have declined, and EBITDA margins declined year-on-year, but was up Q-on-Q. PBT also was down year-on-year and up 83% Q-on-Q. And profit also declined year-on-year, but was up 116% Q-on-Q. Now we'll have to see, compare it the present performance, which is roughly around 1700 crores, to what are they guiding to. So remember this 1700 crores here. Now, what they have guided to for FY25 is roughly 3800 crores. So they have done 1700 crores till now. Would they be able to reach this? This has to be seen carefully. Otherwise, this whole estimate will be lower. They are guiding for around 4600 crore in FY26 and 55 or 5600 crores in FY27, with a profit before tax of around 1400 crores and net profit of around 764 and 1049 crores. So what they are guiding for is that after FY24, FY25 would be flat. So there would be around 8.9% growth, which is again looking doubtful. But after this, FY26 and 27 will see 20% growth and net profit growth of close to 30%. And EBITDA margins would be higher. From this 21% range, they would be 23 and 26%. Uh, so they are guiding for a EPS of around 19 in FY26 and 26 here. So considering value of around 22 as a mean EPS between these two, around 40 times, around 880, 42 times, 40 times with 22 EPS at around 880 should be a fair value for this stock. Now, seeing the chart, this stock is now, in my opinion, rightly fully valued. So use any dip to buy, but one has to be careful with their performance in the next few quarters because in case there is a weak quarter, it can dip very rapidly. Next stock I'll cover is Nalco, National Aluminium. The positive impact of stronger alumina prices, and year-on-year lower power and fuel costs, likely aided by ramp-up of captive coal mining, sharply drove second quarter FY25 performance. Alumina segment performance improved materially. High margin of safety with attractive dividend yield and high cash levels. Despite the ongoing capex projects, cash and cash equivalents at end of FY25 are projected at rupees 4230 crore, which is 10% of its current market capitalization. It sells 1.3 million tons of alumina and zero point 0.4 million tons of aluminum annually and is well positioned to benefit from their strong prices. Steady aluminum price outlook supported by supply tightness due to Alcoa's closure of Guyana refinery, Rio Tinto's declaration of force majeure at Queensland refinery, recent bauxite disruptions in Guinea, and integrated business model provide earning visibility. And additional 1 MTP of alumina along with captive coal mining would drive margin expansion and cost reduction. So if you see their results, year on year, the sales were up 31% and Q and Q around 40% because the first quarter was slightly subdued, while EBITDA was up nearly 3x and up 65% year on year, Q on Q, sorry. And margins have from 13% year on year have reached 38%. So that is roughly 2568 basis points growth. And profit before tax also was up nearly 4x. And EPS was also similarly up from 1.1 to 5.7. So that was a strong performance. This was basically led by the growth in chemicals, that is alumina segment, which grew year on year 36.8%. And overall, the net sales grew 30%. EBITDA of chemical alumina was up nearly 4x, and aluminum EBITDA year on year was up 3x. So total EBIT is up nearly 3x, 3.6x, which is very strong earnings. And for Q and Q also, it was strong. EBIT margins, if you see here, are strong for chemicals, alumina, and for aluminum, they were also up year on year. Aluminum prices were generally up year on year, but declined Q on Q. So one has to monitor this. Now, there is a change in estimate of one of the brokerages for them. So they are expected to do much higher revenues now in next 2-3 years, and EBITDA is also going to be much higher. So change is pretty big in terms of FY27 EBITDA to 6 crore 93 6,093 crores. And aluminium, the basic reason is that alumina prices are expected to be higher based on basic efficiency in supply. So they are expected to get higher prices for their alumina, which is leading to better EBITDA. Now, as per this estimate, because of lack of, and then the alumina price is supposed to go down. So that's why there is estimates are slightly not 100% sure about these estimates. Hence, though based on these estimates, the target price is 265 at 6x of EV EBITDA. So one has to be careful with this. Right now, at least this year will be good. Next year, one has to watch as it is. EBITDA and revenue are expected to be flat next year. So we have seen the EBITDA for and revenue for FY25. So they are expected to around 19 odd EPS for this financial year and similar EPS for FY26. Now, and with the decent growth in FY25 of both revenue, EBITDA, and PAT and EPS. So, with margins improving and then sustaining at around 30% plus levels. So, considering that at 19-20 rupees EPS. Right now, as per estimate, this stock is fully priced. So you can best is to get this only under dips to around this 220-210 levels. Now the next stock is Solar Industries. It expects robust revenue growth in FY25 led by defense, 1,500 crore sales, domestic market, 15% volume growth, and overseas market. Rising scale of defense and overseas business will help further improve profitability with exports and defense scale up. Domestic market share in total sales will fall to 30%. Domestic order book is at 2420 crores. Operations in Australia, South Africa, and Indonesia has turned PAT positive. The new path-breaking explosive products manufactured through in-house R&D are tested by Navy, but could take time to contribute to revenues. It has participated in RFPs of shafts and flares, backed by a strong order book of rupees 3340 crore for defense. It has sustained its FY25 sales guidance of rupees 1500 crore, 20% of consolidated sales. Highly awaited Pinaka rocket order is expected in a month's time. Expect 25% revenue CAGR over FY24-27, while 440 BPS rise in EBITDA margin amid rising defense sales and overseas profitability leads to 36% EPS CAGR. Valuation will be aided by market leadership in license controlled explosive industry with high entry barriers, rising volume, better profitability, and Pinaka-led defense scale-up. Now, coming to the revenues, the revenues were up 27% year on year and generally flat Q on Q. And EBITDA has improved 32% year on year. This is because the EBITDA margins are improved. So from this 19 odd percent, now they have reached to 25-26%. And this is what is leading to higher profitability despite uh, lesser growth in the uh, revenues. So the EPS growth is strong, roughly 42%. So EPS from around 20 odd levels, 22 levels, it has reached now 30 plus levels. So this is now becoming a norm because of higher EBITDA margins in the defense and exports business. Now they have basically revenues coming from Coal India, which have declined. Other institutional sales, infrastructure sales, which have also declined, but exports and defense have increased year on year. Exports have gone up by 25% and defense has gone up by 203%. Revenue mix has also improved and it is now primarily exports and defense, and which is while explosive, that is domestic revenue, is up 5% only year on year and declined Q on Q. Now their sales mix has improved with respect to defense and exports, which is favoring their basic EPS and EBITDA. So the defense order book is now roughly around reached around 3,500 crores, with defense revenue reaching around 320 odd crores and rising now. So this is what is driving the margins. They are expected to do around 10,000 crores of revenue in FY26 with the profit after tax of 1786 crores. And so the growth which is expected is strong over FY25 and 26 and 27 with strong EBITDA improvement, EBITDA margin improvement from 18 or 19 to around 26, 27, and PAT growth also to be strong around 17, 18%. So they are expected to do an EPS of roughly around 190 to 232. So taking a mean of around 220 over FY26, 27, at 40 times they should trade at around 8,800. So 8,500 to 9,000 should be a fair value. Now, seeing the chart, this is a weekly chart. The stock had a steady rise from around 3,000 levels. It rose and went up to 13,000 and then it has declined. So, roughly around 8,500, 9,000 should be a decent level to get this stock for long term. I finished. We will take questions now.